In April 2010, the price of silver suddenly plunged within minutes. According to market data from that day, thousands of futures contracts were sold in a short burst during thin trading hours. Traders watching the screen saw prices drop sharply before stabilizing. The question that followed was direct. Was this normal market activity or something more deliberate? Silver is not just a precious metal. It is traded globally through futures exchanges, over-the-counter derivatives, physical bullion markets, and exchange-traded funds. Prices are influenced by industrial demand, investment flows, currency movements, and macroeconomic conditions, but they are also influenced by large futures positions held by financial institutions. By the late 2000s, silver markets had become increasingly financialized. Investors were buying exchange-traded products backed by silver. Hedge funds and banks were active in futures markets, such as those operated by the Chicago Mercantile Exchange, which includes COMEX contracts. At the same time, silver prices were rising. Following the 2008 financial crisis, investors sought assets perceived as hedges against currency risk and inflation. According to historical pricing data, silver rose from under $10 per ounce in 2008 to nearly $50 per ounce by 2011. As prices climbed, so did speculation. Market participants began raising concerns about concentrated short positions. According to public data published by the Commodity Futures Trading Commission, large trader reports indicated that a small number of commercial traders held significant short exposure in silver futures. Short selling in futures markets is legal and common. A trader selling a futures contract is agreeing to deliver silver at a future date, often as part of hedging activity. However, critics argued that the size of certain concentrated short positions appeared unusually large relative to market size. Beginning around 2008, complaints were submitted to regulators alleging that certain banks were suppressing silver prices through large short positions. The CFTC opened a formal investigation into possible manipulation of the silver market. According to regulatory statements issued at the time, investigators reviewed trading data, position concentrations, and communications. In 2013, after several years of review, the CFTC announced it was closing the investigation without bringing enforcement action. According to the agency's public statement, investigators did not find sufficient evidence to prove a violation of federal commodities laws. However, concerns about silver market integrity did not disappear. In subsequent years, enforcement actions emerged in related contexts. In 2020, the U.S. Department of Justice announced criminal charges against traders at Morgan Chase for spoofing precious metals futures markets, including gold and silver. According to court documents, spoofing involves placing large orders with the intent to cancel them before execution, creating a misleading impression of supply or demand. In subsequent proceedings, Morgan agreed to pay substantial fines and entered into a deferred prosecution agreement. Court documents showed that certain traders pleaded guilty to spoofing charges. The bank did not admit broader market manipulation beyond the specific spoofing conduct described. In the settlement, the distinction between spoofing and long-term price suppression is significant. Spoofing cases involve deceptive order placement tactics that influence short-term price movements. Allegations of systemic price suppression through concentrated short positions involve broader claims that were not proven in regulatory proceedings. Meanwhile, silver's volatility continued. In early 2021, social media-driven trading campaigns encouraged retail investors to buy silver. Citing theories about concentrated short positions, prices briefly surged before retreating. According to market data and exchange reports, increased margin requirements and heavy trading volumes contributed to the volatility. Throughout these episodes, regulators maintain that they actively monitor commodity markets for manipulation. According to CFTC enforcement reports, the agency has pursued multiple cases involving spoofing, false reporting, and other violations in precious metals markets. The core question remains complex. Did silver traders get away with market manipulation, or did regulators simply lack sufficient evidence to prove systemic wrongdoing? Part of the challenge lies in defining manipulation. Under U.S. law, proving market manipulation requires demonstrating both intent and the ability to cause artificial prices. According to court standards cited in enforcement actions, price movement alone does not establish illegality. Silver markets are influenced by legitimate hedging by mining companies, industrial users, and financial intermediaries. Concentrated positions can reflect commercial needs rather than coordinated schemes. At the same time, Enforcement actions against spoofing show that illegal tactics have occurred within precious metals trading. The rise in silver prices over the past decades, the sharp intraday drops, the investigations that closed without charges, and the later criminal cases related to spoofing all form part of a larger narrative about transparency in commodity markets. The next phase of this story looks deeper at the mechanics of alleged manipulation and what regulators ultimately determined about the structure of the silver market. After the 2008 financial crisis, silver markets entered a period of unusual volatility. Prices rose sharply through 2010 and into 2011, according to widely reported data. Silver approached $50 per ounce in April 2011 before retreating rapidly. During that rise, public debate intensified over whether price movements reflected natural supply and demand, or something more coordinated. Central to the debate were the weekly commitment of traders reports, published by the Commodity Futures Trading Commission. These reports classify futures positions into categories, such as commercial hedgers, managed money, and other reportable traders, according to publicly available data. A relatively small number of commercial traders at times held a significant share of total short positions in silver futures. Critics argued that concentrated short exposure by large banks could suppress prices. However, regulatory analysis distinguishes between short positions taken for hedging and those taken for speculative manipulation. Mining companies, refiners, and financial intermediaries often hold short futures positions to hedge price risk. According to regulatory filings, banks frequently act as intermediaries for clients, offsetting risk exposure. Between 2008 and 2013, the CFTC conducted a multi-year investigation into potential manipulation of silver markets. According to official statements released in 2013, investigators reviewed millions of documents and trading records. The agency stated that it did not find sufficient evidence to bring enforcement action related to price suppression. That conclusion did not satisfy all market participants. Some investors argued that concentrated positions alone indicated market power. Regulators, however, are required to prove that price levels were artificial and that traders intentionally caused those artificial prices. The legal threshold is high, according to federal court standards cited in commodities cases. Establishing manipulation requires demonstrating that a trader had the ability to influence prices, that an artificial price existed, and that the trader intended to cause it. In the absence of clear evidence of artificial pricing, the CFTC closed its silver investigation in 2013 without charges. In subsequent statements, officials emphasized the difficulty of proving systemic manipulation in complex, globally interconnected markets. However, enforcement activity did occur in related areas. In 2019 and 2020, the U.S. Department of Justice brought criminal cases against precious metals traders at Morgan Chase and other institutions. According to court documents, traders were accused of spoofing futures contracts in gold and silver markets over several years. Spoofing involves placing large orders with the intent to cancel them before execution, creating a false impression of market depth. In 2020, Morgan agreed to pay approximately $920 million to resolve investigations into spoofing and related conduct in precious metals and treasury markets. According to the deferred prosecution agreement, the bank acknowledged misconduct by certain traders but did not admit to broader systemic price suppression. Several individual traders pleaded guilty to criminal charges. Court documents showed that these cases focused on specific order placement tactics rather than long-term control of prices. The distinction matters. Spoofing can affect prices in the short term by influencing order books and triggering algorithmic responses. It does not necessarily prove that traders controlled overall price trends over years. Meanwhile, silver markets continue to evolve. Exchange-traded products backed by physical silver grew in popularity. Retail investor participation increased, particularly during the surge in early 2021 when social media-driven buying pushed prices higher. For a brief period, during that episode, exchanges raised margin requirements to address volatility. According to exchange notices, such changes are routine tools used to manage risk during periods of rapid price movement. The silver market is global. Physical bullion trades in London. Futures contracts trade in New York. Over-the-counter derivatives operate across jurisdictions. According to regulatory reports, this fragmentation makes proving coordinated manipulation more complex. In regulatory proceedings, Agencies consistently emphasize that large positions alone are not illegal. What matters is whether prices are artificial and whether intent to manipulate can be demonstrated. So did traders get away with manipulation in formal regulatory terms? Long-term systemic price suppression was not established in the silver investigation that closed in 2013. However, individual spoofing cases led to fines and criminal convictions in later years. The narrative is therefore mixed. Allegations of broad price control were not proven under legal standards, yet documented misconduct occurred in specific trading tactics. The final part examines why silver remains a focal point for manipulation debates, and what lessons regulators and investors have drawn from decades of controversy. After more than a decade of public accusations, regulatory reviews, and criminal cases, the silver market controversy remains layered rather than simple. On one side are formal regulatory conclusions. In 2013, the Commodity Futures Trading Commission announced that its multi-year investigation into silver market manipulation would close without enforcement action related to alleged long-term price suppression. According to the agency's public statement, investigators did not find sufficient evidence of violations that met the legal standard for manipulation. That outcome meant no charges were brought for systemic control of silver prices. On the other side are confirmed enforcement cases. In 2020, the U.S. Department of Justice and the CFTC announced settlements and criminal resolutions involving precious metals traders at Morgan Chase. According to court documents and regulatory filings, traders engaged in spoofing, placing orders they intended to cancel to create misleading market signals. Under the settlement terms, Morgan agreed to pay approximately $920 million in penalties related to spoofing and related misconduct in precious metals and treasury markets. Several individual traders pleaded guilty or were convicted in connection with spoofing activities. These cases were supported by documented trading records and internal communications presented in court. The legal findings were specific. They addressed deceptive order placement tactics over defined time periods. They did not conclude that silver prices were controlled over the long term or that a coordinated effort suppressed prices over decades. That distinction has shaped public perception. For some market observers, enforcement actions validated concerns that precious metals markets were vulnerable to abuse. For others, the absence of a proven systemic manipulation case suggested that broader conspiracy claims lacked sufficient evidence. Commodity markets are structurally complex. Silver prices reflect physical supply, industrial demand, investment flows, currency movements, and macroeconomic conditions. Futures contracts allow hedging and speculation. Large banks often act as intermediaries for mining companies, refiners, and institutional investors. Concentrated short positions can appear alarming, but according to regulatory filings, such positions may represent client hedging activity rather than directional bets by the banks themselves. Regulators require proof of intent and artificial pricing to establish manipulation. In subsequent proceedings, courts reaffirmed that proving manipulation requires demonstrating both intent and causation, not simply volatility or market concentration. Silver's volatility has continued. Prices rose sharply during the early months of the COVID-19 pandemic and during retail-driven buying episodes in 2021. Exchanges adjusted margin requirements in response to rapid price changes, citing risk management considerations in official notices. Despite recurring debates, no regulatory body has concluded that silver traders secretly controlled the market in a sustained, systemic manner. However, documented spoofing cases show that illegal tactics occurred within precious metals trading. These enforcement actions reinforce the importance of surveillance systems, audit trails, and cross-market cooperation. The silver controversy highlights a broader issue in financial markets: the gap between suspicion and proof. Markets with high leverage and rapid electronic trading can produce sharp price swings. Allegations of manipulation often follow, but legal standards require documented evidence of intent and artificial pricing. In this case, regulators pursued years of investigation. They brought charges where evidence supported specific violations. They closed investigations where the burden of proof was not met. So did silver traders get away with market manipulation? In formal legal terms, systemic long-term manipulation was not proven in the major investigation that concluded in 2013. In parallel, individual traders were prosecuted for spoofing in subsequent years. Both facts coexist. For investors, the lesson is practical. rather than dramatic. Commodity markets are regulated, but they are not immune to misconduct. Enforcement depends on evidence, documentation, and legal thresholds. Silver remains a globally traded asset shaped by macroeconomic forces, industrial demand, and financial speculation. Its history includes volatility, allegations, investigations, and confirmed violations of specific trading rules. Understanding that layered history is more accurate than a single headline. If you value clear, fact-based analysis of financial controversies and market enforcement cases, consider subscribing to the channel for future documentaries.